As we continue our journey on managing credit, we're going to start talking about evaluating our credit and the credit laws that are out there. And I'm going to refer you somewhere for all of these in the textbook. But evaluating our credit, we're going to look at credit scores and credit ratings. So credit bureaus, like we talked about in the last section, evaluate consumers based on information in their credit file or their credit report. These credit bureaus all are pulling information from creditors to come up with their report or assessment of you on whether or not you're credit worthy, whether people should lend you money or not. And the big difference between these two things, scores and ratings, is scores, as you would expect, is a numerical number that's assigned, and credit ratings are words, so like grades. So an A rating, a B rating, a C rating are excellent, fair, something like that. So the credit scores are pulled together based on some point system. And the point system is looking again at your borrowings and your repayment history and these types of things in order to give you points for each type of thing. And they add all these points up, and that is what your score is. So as you would expect, the higher your score, the better. And it means that you are more likely to repay your debt. So you're a good credit risk. So the most common one used is something called FICO, and I think it stands for like Fair Isaac Company or something like that is the name of the company. But I think they say that over 90% use this measure, this FICO measure. The three credit bureaus all have a FICO score for you, and their FICO score may not be the same because each bureau may pull different credit information from lenders and creditors. So because they're using different information to compute the score, it could be somewhat different, but it shouldn't be substantially different. And then we're going to talk about the inquiries into your credit and then how you can improve your credit score. So to calculate a FICO score, you have to have at least one account open for 6 months or more. So you have to have a credit account, a credit card, or a loan, or some other type of credit open for 6 months or longer. The highest score that you could get is 850, and the lowest is 300. And they're based on these things. So again, we talked about this already, that it's all based on history as well as recent activity on new credit and things that you have come up with. So there's a pie chart on page 187 in your book that kind of goes through the percentages, but 35% is based on payment history. So are you past due? Is it being collected on time? Things like that. 30% is on amounts owed. Less is better, of course. The length of credit history, 15% on that. And the longer that I've had something and continued to pay on it, the better. The types of credit used is 10%. So credit cards, mortgages, car loans, what types of credit are you using? Revolving, line of credit. And then the last one is 10%, which is any new credit. What have you been getting recently? A credit inquiry is when a business, for a permissible purpose, tries to find out what your credit score is and what's on your credit report. So they can make inquiries to find out what it is, and that doesn't necessarily count against you, that a lot of people are trying to do it. And if you do it yourself, like we talked about, you can get it once a year free, but if you're looking into your credit as well, that does not count against your score. Authorizing the lender to check on your credit for a loan, though, will affect your FICO score unless you're just rate shopping for the best interest. But if they're using it to make a decision, that will count against, because you're getting more credit. And then too many inquiries mean that too much debt is being taken on. So the more I keep doing it, the more they're starting to worry that I'm borrowing a lot and won't have the ability to repay. So if my FICO score is not as high as I would like, here's a few things that you can do to fix it. Pay bills on time, improve your payment history, keeping at it, getting it done, keeping balances low on all your revolving credit and credit cards, paying off your debt rather than just opening a new one to pay off the old, but actually get it paid off and behind you for good. And then not doing a ton of open accounts at once. So don't fill out 5 credit card applications as soon as you get out of college. So that was credit scores. Now credit ratings are a measure of credit worthiness too, based on the analysis of your history. And here are the ratings, and you have to do this in the workbook as well, that they use. So there's an A rating, B, C, D, and as you would expect, A is the best. You haven't missed payments, you're paying off debt early. D is the worst. You're probably going to get denied credit because you've been missing payments and you have other risk factors too in the past, like bankruptcy or things like that. So this is a continuum, an A to D rating. And if you look at, I think it is on page 189 of your book, they give you the FICO score, credit score, and the rating, so that you know that a credit rating of A is from 720 to 850. A credit rating of D is below 575 on a FICO score. So that tells you everything you need to know about credit scores versus credit ratings. And you're going to do an activity where you will calculate FICO scores for someone and see the impact of different parameters on that score. So now we're going to move on to credit laws, and I am actually just going to flip these up there rather quickly. So there's the Congress basically has passed all these laws in order to try to protect consumers. And this Truth in Lending Act is a big one. So it requires them to tell consumers about all the costs of the credit. So any interest charges, late penalty fees, any costs associated with it, they have to disclose that to you before you make the purchase. Then there's this Fair Credit Reporting Act, which is all about collection of your information. And it talks about the Fair Credit Billing Act resolving all your billing errors within a specified period of time. So when you get a statement from someone and you have a dispute with them, they have to resolve that error with you before they can continue to charge you for late fees or interest or things like that. Then the Equal Credit Opportunity Act is just like it sounds. So it's about not discriminating based on race, age, any of those factors when trying to decide whether or not you are worthy of credit or not. So this one is talking about debt collectors, the people that come try to collect your overdue account, and it eliminates any abusive practices, so, breaking your bones and those kinds of things in order to try to collect. But also in your textbook, if you look at these, they're on page 189 to 192. Make sure you take a look at the other two that are in there, the Credit Card Accountability, Responsibility, and Disclosure Act. That is a huge one. It is basically called the Credit Card Act. And that's the one that says that they have to give you 45 days notice before they change anything substantially. And there's lots of disclosure regarding how you get interest computed, and the type of billing and all those kinds of things. And the biggest part for you guys is the fact that it's the one that protects youth or younger people from getting abused. So there's lots of rules around someone under the age of 21 and what they can do to try to get you hooked on a credit card. And then the last one is the Dodd-Frank Wall Street Reform and Consumer Protection Act, also to me known as the Dodd-Frank Act. And this one was just after one of the financial collapses that went in and basically tried to protect people from kind of these big credit card companies and some of the things that they're doing. So you could read about that on page 193. So there are a lot of laws that are out there that are made to try to protect you. So at the end of this whole chapter or section, you need to understand what credit scores are, FICO being the most common, and then credit ratings, the ABCD ratings, and how that works, and then finally what all the different credit laws are that protect you as a consumer.